If you've ever watched a stock go from nobody cares to why is it up 40% in a week, you already know the rule. The biggest moves usually start when the chart looks ugly, the headlines feel messy, and the crowd has given up. Today we're building a higher risk, high upside watch list of 5 US listed stocks trading around $5 or less. And we're doing it with one goal: find names that could make a sharp move as we close out 2025 and head into 2026. Because our catalysts don't wait for perfect sentiment. Quick reality check before we jump in. Nothing here is a promise. And explode is just YouTube language. ESCOs can pop, but they can also drop fast, especially at these price levels. So this is for learning and research, not a go by this list. If you're younger, talk to a parent, guardian, before touching real money. And if you're any age, always size your risk, like the market can humble you tomorrow. With that said, all prices I mention are as of the last U.S. trading day. December 24th, 2025, markets are closed, December 25th, and we're starting with a name that basically defines the phrase controversial turnaround. First up, Plug Power, ticker Plug, last around $2.10. The bull case is simple to understand and hard to execute. Plug is trying to become a real hydrogen platform equipment plus fuel at a time when clean energy incentives and industrial demand can be huge tailwinds, but only if the company can stabilize cash burn and prove it can run assets reliably. On the evidence side, Plug highlighted record performance at its Georgia Green hydrogen plant, including 324 metric tons of liquid hydrogen produced in August with 97% uptime, along with broader liquidity improvement efforts and business updates in its K3 2025 highlights. That matters because for a company like this, reliability is the difference between story stock and supplier. Add to that a real customer validation moment. Plug landed its first contract with NASA up to $2.8 million to deliver liquid hydrogen to NASA facilities in Ohio land. Plug pointed out NASA's massive hydrogen demand as a potential longer runway if performance checks out. Now, here's why the stock is still down here. Financing and dilution fear. Plug recently announced a $375 million convertible notes, deal expensive money, but also partly used to refinance. Even higher interest, debt showing management is in survive and extend runway mode. And there's also the Department of Energy loan story. Plug previously received a DOE loan guarantee announcement for clean hydrogen projects, but later reporting indicated Plug warned that pausing door-related activities could risk the loan guarantee process, exactly the kind of uncertainty that keeps a stock pinned. So what's the before 2026 setup? It's not magic, it's the idea that if the market sees continued operating improvements, clearer liquidity, and more credible demand signals like NASA-type wins or big electrolyzer deliveries, Plug can re-rate quickly from possible bankruptcy someday to speculative turnaround. And that shift in narrative can move a $2 stock hard in either direction. Second on the list is a name that surprises people because it's not a meme, not a biotech coin flip. It actually has a business that shows up inside hundreds of millions of devices and cars. BlackBerry, ticker BB, last around $3.99. A lot of people still think old phones. But the modern BB story is cybersecurity plus embedded software. And the embedded part is the sleeper. Reuters reported BlackBerry raised the lower end of its fiscal 2026 revenue outlook to a $531 million, $541 million range. After Q3 revenue of $141.8 million topped expectations, and it highlighted QNX, the embedded software Unibian, used in over 275 million vehicles globally, with QNX revenue up 10% year over year to $68.7 million. That's huge because QNX is the kind of infrastructure software that can quietly compound. It's not flashy, but once it's designed into systems, it tends to stick around. If the market starts rewarding real revenue plus guidance, lift plus profitable quarters again, BB has a clear path to sentiment improvement. The near-term catalyst vibe here is earnings momentum plus a narrative shift. Cybersecurity demand is rising. AI-driven threat complexity is rising. And BB is literally telling the market its floor is higher than it thought a quarter ago. The risk is that it's still a turnaround, and the market can be impatient, growth slows, or margins disappoint. This stock can chop sideways forever. But if you're hunting under $5, names that can move. BB is one of the few that can pop on fundamentals instead of just hype. Third is the wildcard that still has one of the loudest retail communities in the market. AMC Entertainment, ticker AMC, lasts around $1.68. This one is not for the faint of heart because the business is heavily leveraged. The stock is sensitive to dilution headlines, and the entire theater industry is constantly fighting the question, are people going to keep showing up? Recently, AMC ended an 11-day losing streak on December 24th, while broader concerns remained. and coverage pointed to ongoing anxiety about the industry and AMC's financial position. MarketWatch reported AMC disclosed amendments to its debt terms, including a $6.25 million payment in stock to noteholders and the possibility of additional stock offerings up to $150 million. Exactly the kind of headline that spooks shareholders because it screams dilution. Another filing summary noted these ATM offerings, up to $150 million. Net proceeds can occur before February 2, 2026. So that's a very specific timeline investors are watching. On the flip side, AMC's management has been working the liability side. AMC announced closing refinancing transactions intended to strengthen the balance sheet and reduce near-term maturity pressure, specifically targeting debt due in 2026. And in its Q3 2025 results, AMC reported total revenue of $1.300 billion and a net loss of $298.2 million, with the company attributing much of the increased loss to non-cash charges tied to prior refinancing actions, meaning the headline loss number isn't the full story of cash operations, even though the situation is still tough. So why is AMC on a could explode list? Because it's basically a coiled spring of sentiment. If box office expectations for 2026 firm up, if refinancing continues to push maturities out, and if the market senses dilution risk is more managed than constant emergency, you can get violent upside moves, especially when a stock is already beaten down. But the bear case is equally real. If AMC leans on equity issuance again, or if attendance stays weak, the stock can bleed lower. This is a watchlist name, not a sleep well at night name. Fourth is Microvision, ticker MVIS. Last around 91 cents, MVIS is a classic optionality stock. The market is pricing it like a long shot. But one meaningful contract, partnership, or defense win can reset the entire valuation, because at under $1, expectations are basically underground. The most important recent development is that Microvision has been reshaping its tech and strategic footprint. The company announced it executed an agreement to acquire Scantinel Photonics, a German developer of long-range FMCW LiDAR, aiming to expand its product portfolio beyond its existing time-of-flight LiDAR and deepen its position in automotive and commercial markets. That's not just more tech, it's a strategic bet that FMCW LiDAR can matter. And if OEMs or defense buyers prefer that approach, MVIS wants to be in the conversation. They also pushed into defense more directly, announcing a new aerial systems team in Virginia office with testing facilities to accelerate LiDAR-based perception systems for drones and ISR-focused applications. Again, not a guarantee of contracts, but a clear push into a customer set with big budgets if you can meet requirements. And MVIS ended Q3 2025 with about $99.5 million in cash and investment securities. Which matters because small-cap tech stories often die from funding risk before they ever get to the big win moment. The before 2026 angle here is momentum and narrative. Acquisitions, product expansion, and defense positioning can drive speculation. And in microcaps, speculation itself can move price. The risks are obvious. Commercialization is hard. Timelines slip. And if cash burn accelerates without revenue traction, the market punishes you. Still, as a pure asymmetric setup, MVIS belongs on the list. Fifth and final is Transocean, ticker RIG. Lasts around $4.01. RIG is different from the other four. It's not mainly a no-tech, dream story, it's a cyclical offshore drilling company, and the catalyst is the offshore market itself. When offshore tightens, day rates and backlog improve. When oil prices soften or demand expectations drop, the whole group can get sold. Recently, Transocean announced new backlog adds and contract extensions. Investing.com reported about $89 million in new backlog from extensions, including Petrobras exercising an option that added roughly $33 million. Another industry report said Transocean added around $130 million to backlog with a new drillship deal and options at day rates in the mid-$300,000, which signals that work is still being booked even late in the year. In its Q3 2025 results, Transocean reported contract drilling revenues of about $1.03 billion, and third-party summaries highlighted average daily revenue around $462,000 strong, indicators for a contractor if utilization holds up. The company has also talked about retiring rigs, with an earnings call transcript pointing to retiring 9 rigs with completion by mid-2026. Moves like that can tighten the fleet and improve economics if demand stays steady. The explode setup here isn't about a single press release, it's about the market waking up to backlog durability or improved offshore economics, especially if oil stabilizes and investors rotate into energy names. The risks. Offshore is cyclical. Debt matters, and oil price expectations can flip fast on macro news. So, how do you use this list without getting wrecked? Treat it like a research sprint. For each stock, pick one metric and one catalyst you'll watch in the next few weeks. Plugs liquidity and plant performance updates. Plus, any clarity around government financing. BlackBerry's next quarterly results and whether QNX growth holds. AMC's box office trend plus the dilution ATM timeline. Microvision's progress integrating Scantinel and any defense or OEM traction. Transocean's backlog updates and day rate commentary. And remember the most important rule for sub $5 stocks. The price being low doesn't mean the stock is cheap. It means the market is nervous. That nervousness is exactly why these can explode, but it's also why they can implode. If you want the upside, you have to respect the risk, because the market doesn't care about our captions, our thumbnails, or our predictions. It cares about cash flow, balance sheets, execution, and timing. If you want a part 2, I can do a red flags checklist for these exact 5 names. What would make each one a no-go and a catalyst calendar? Style watch plan you can follow into the first weeks of 2026.